Looking at historical stock markets, there were 5 similarities, which were very decisive features of 3 stock market crashes. These features include number 1, a rally along a clearly discernible trend line on a linear chart. Number 2, an accelerated move toward the peak at the end of the advance. Number 3, an initial decline testing the trend line. Number 4, a counter trend rebound. And number 5, a break of the trend line. So today we're going to take a look at the 1929 crash, the 1987 crash, and the Japanese Nikkei crash of 1990. And after you are all suitably concerned, I will cheer you up with one more chart. So let's take a look. This chart here is the S&P 500 going back to 2015. And based on those similarities and the decisive features, we first see number 1, which is the rally all along the discernible trend line going through here. Number 2, the accelerated move to the peak at the end of the advance. Number 3, the initial decline testing the trend line. Number 4, a counter trend rebound up to this point here. And then number 5 similarity of the other 3 crashes was a break of the trend line. And although we've come down here to the trend line, and even though we've gone through it, this doesn't necessarily qualify as a break of the trend line, at least not yet. Now, as you can imagine, after the break of the trend line in the other 3 crashes, waterfall declines began. So let's take a look at the next chart. This chart here is the Dow Jones Industrial Average beginning in January 1928 and going through the similarities. Number 1, here's your rally along the discernible line. Number 2, the accelerated move through this point here toward a peak at the end of the advance. Number 3, the initial decline moving down here, testing the trend line. Number 4 was a counter trend rebound up to this point here. And then number 5 was a break in the trend line and the plunge down to this point here. So the move from 380 at the top down to 200 was a nice decline of 47%. Let's go to the next chart. And this is the Dow Jones Industrial Average beginning in about April of 1986. And here is your rally along the trend line. The accelerated move began here up to the peak just above 2,700. Then the initial decline testing the trend line, the counter trend rebound to this point here, and then the break of the trend line down to this point here at around 1750. And from the peak of just over 2,700 down to the bottom at 1750 was a nice decline of about 35%. Now, if you can take a look at the chart a little bit more closely, you see this little point there? That's me. I was in Rome, Italy at the time, didn't read or speak the language, but I saw a newspaper in Rome. All it had was DOW and a chart. Easy enough for me to understand what had happened. I still had a good vacation. Let's go to the next chart. And this chart here is the Japanese Nikkei beginning in about June of 1987. Beginning here, we have the rally along the trend line. And I would imagine that this here is the accelerated move to the peak reaching toward 39,000. And then the initial decline, testing the trend line with a very moderate counter trend rebound here, if you can see that. And then, of course, the break of the trend line and kind of in 2 different phases all the way down here just above 20,000. And so from about the peak of near 39,000 down here to the bottom, that was also a very nice move down of about 47%. And of course, this was during the time that everybody thought that Japan was going to buy up the world, but that did not happen. So let's go to the next chart. And this chart here is the S&P 500, and it overlays the three other stock markets that we talked about. And with the recent trendline break by the S&P 500, the pattern of the stock market continues to look similar to the previous three stock market crashes. Other factors of crucial importance include the extreme fundamental overvaluation that we have currently, rising interest rates, the specter for further rising interest rates, and of course, the tensions over global trade. Remember that a crash is by no means certain, as we'll see here in this next chart. And then this last chart here is to show you that everything is not doom and gloom. And this shows you the overlay of the current market. It indicates February 2018. However, the chart actually goes into March 2018, and it overlays the decline that we had in August of 2015. And in August 2015, we recovered from that and continued on for several more years. Now, the difference from August 2015 and today is that in August 2015, we had central banks pumping currency into the markets and buying stocks as well as bonds across the world. We may not have that today, so it remains to be seen where we go from here. So that's something for you to contemplate. And for today, that's ChewDog Charts. Thank you.